Hey everyone. Of course, Cathie Wood is one of the most popular investment managers today, known for her investments in innovative tech companies like Tesla. In this video, I've got one Cathie Wood stock that she's been buying lately that's down 84% off the high that I think makes an excellent investment for long-term investors. So in this video, I'll share what that growth stock is and why I think it makes an excellent investment today.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the stock I'm talking about in this video is Sea Limited, the e-commerce company and gaming company, you can say. It also has financial services as well, and it's down 84.16% off the high. And I can share with you, Cathie Wood here made a 76,000 share purchase on March 12th of Sea Limited. Also, Cathie Wood made a 30,000 share purchase on March 11th. So Cathie Wood has been purchasing large increments of Sea Limited stock, and understandably so. I think it's an excellent investment. One of the reasons why I think Sea Limited is an excellent investment is because of the growth it demonstrated in recent years. 13.06 billion in revenue is up from less than 2 billion in revenue in 2019. Now, while I don't think Sea Limited is going to grow at the rate of growth it increased in the last 5 years, I think it's got solid double-digit growth prospects ahead, and I'll share with you what Wall Street thinks about Sea Limited's growth prospects a little bit later in the video. Now, one of my favorite things about Sea Limited is since its growth rate slowed down in revenue, the company made significant progress on profitability. You can see its operating profit margin increasing to 2.62%, up from negative 100% in 2019. So the company made a strategic focus on profitability and less so on revenue growth. And I think that was a solid trade-off, a prudence trade-off for management, especially since 2022, when central banks worldwide increased interest rates and the cost of capital increased. That made it more important for companies like Sea Limited to generate profitability on the bottom line, because those losses were hurting. The opportunity cost of those losses on the bottom line were increasing meaningfully. Now, I told you I would share with you Sea Limited's growth prospects for the next couple of years. And for 2024, analysts on Wall Street are expecting Sea Limited to grow revenue by 14.9%, and then for Sea Limited to grow revenue by 12.8% in 2025. Solid double-digit growth expectations for Sea Limited over the next 2 years. Analysts on Wall Street expect Sea Limited to increase their earnings per share at 128% next 5 years per year. Per year, 128% increase in earnings per share over the next 5 years. So like I mentioned earlier, the company is focusing on profitability more so than generating top line growth, and that attracts me as an investor more so than revenue growth. If you've been following my channel for a while, you'll know that I'm more interested in profit growth and cash flow growth than I am in revenue growth. I think it's easy to generate revenue if you're willing to generate losses on the bottom line. You can create an excellent product that costs you $1,000 to create that product, and you could sell it to customers for $100, right? And generate a 90% loss. Of course, customers would flock to your product and you would be sold out and you would be demonstrating phenomenal growth rate, expanding overseas, etc., right? But you would be losing so much money on the bottom line, and that's not a real business. If you were to charge customers what it costs you to make that product, you would get far fewer customers. And then where will your business be? So for that reason, I'm not too impressed with companies that are generating phenomenal growth while losing significant sums of money on the bottom line. When I see companies that are losing money on the bottom line, I look for progress towards profitability. I look for improving economies and scale. And this is something that I've seen with Sea Limited. They've made progress and now they're profitable in terms of operating profit margin over the trailing 12 months. So in addition to solid operating profit margin improvement, C Limited is sustainably cash flow positive, 15.92% in cash flow from operations to sales in the trailing 12 months. This is up from negative 40% in this metric in 2019. While it has been volatile, you can draw a solid trend line here from the 2019 number all the way up here to the 2024 number, and you could see a trending improving cash flow from operations to sales. This metric measures how much of a company's sales it's able to turn into cash flow from operations. And that's the name of the game, turning sales into cash. You can generate more sales if these sales are not turning into cash, similar to how you can generate more revenue by taking losses on the bottom line. You can generate sales that don't turn into cash. I'll give you one example. You could sell your product for $1,000 when you can get it from a competitor at $500. You can sell your product for $1,000 if you're willing to offer very generous credit terms to your buyers. You tell the person buying your product, look, pay me $1,000 for the product, but you don't have to pay me today. You could pay me 5 years from now, or whatever generous payback term you make, right? So that'll generate sales, but those sales are on an accounts receivable basis. They're not on a cash basis. And so if you continue generating sales in that fashion, a significant percentage of your accounts receivable will not turn into cash, right? Significant percentage will go unpaid. Some of your customers will just not pay you back. That's just the way credit goes. And so that's less impressive in terms of revenue generation than it is when your sales are turning into cash flow. That's why I place great importance on this metric, the cash flow from operations to sales. And I do see improvement, and I do see a solid number here for C Limited. And finally, the stock is relatively cheap. C Limited is trading at a forward price to earnings of 19.6, and this is arguably the cheapest you've been able to buy this stock going back all the way to 2022. Of course, you've had moments where you could have bought it for a little bit less than where it's at today, but maybe its prospects weren't as great as they are today, with its earnings per share expectations of 128% improvement every year for the next 5 years. So you've got a company that's growing revenue at double digits expected for the next 2 years, and earnings per share growth expected in the triple digits for the next 5 years. I can understand why Cathie Wood is buying this stock, and I would recommend this stock as a buy. I have C Limited stock rated as a buy, and I think it's one growth stock that long-term investors can feel reasonably good about adding to their portfolios. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.